Inherited property is one of the friendliest basis rules in the tax code. In most cases, your basis is the property's fair market value on the decedent's date of death, not what they paid, not their adjusted basis. This wipes out the decedent's built-in gain or loss for income tax purposes. On the EA exam, they'll give you the decedent's basis to distract you. Ignore it unless a special rule applies. That FMV at death rule can create a stepped-up basis or a stepped-down basis. If the asset appreciated during the decedent's life, your basis jumps up to FMV, shrinking your future taxable gain. If the asset dropped in value, your basis drops to FMV, which can reduce or even eliminate a future loss. Exam tip: always compare date of death FMV to what the decedent originally paid to label it step up or step down. Inherited property also gets a special holding period rule. When you sell inherited property, it's treated as long-term capital gain or loss, no matter how long you actually held it. Even if you inherit it on Monday and sell it on Friday, it's still long-term. On the EA exam, this is a classic trick. They'll tempt you to call it short-term because the beneficiary held it briefly. Now the curveball, the alternate valuation date. For estate tax purposes, the executor can elect to value the estate 6 months after death, but only if it lowers both the estate value and the estate tax. If that election is made on Form 706, the beneficiary's basis generally becomes the FMV on that 6-month date, not the date of death value. This is tested a lot because it changes the basis number you pick. One more timing rule with alternate valuation. If an asset is distributed to the heir before the 6-month date, the basis is the FMV on the distribution date instead. If it's distributed after 6 months, you use the 6-month value. And if no Form 706 is filed, you're back to the default, FMV at date of death. On exam questions, build a quick timeline: death date, 6-month date, and distribution date. Marissa inherited 100 shares from her father, who died May 3, 2023. Dad's adjusted basis was $42,000. The stock's FMV on the date of death was $78,000. 6 months later, November 3rd, it was worth $72,000. The executor distributed the stock December 7th, when it was worth $71,000. A Form 706 is required, and the executor elected the alternate valuation date. What is Marissa's basis? Think about it. The answer is $72,000. Because the executor elected the alternate valuation on Form 706, the general rule is the heir's basis is the FMV 6 months after death. $71,000 is tempting, but that distribution date FMV only applies when the asset is distributed before the 6-month date. Here, distribution happened after 6 months, so you stick with the 6-month value. Ethan and Sophia are married filing separately and don't live together. In 2023, Ethan sells 300 shares of Hawthorne stock at a $4,000 long-term loss with no other capital gains or losses. 15 days later, Sophia buys 500 shares of Hawthorne stock. How does Ethan report the sale on his separate return? Think about it. The loss is disallowed under the wash sale rules. Buying substantially identical stock within 30 days before or after the loss sale triggers wash sale treatment, and a spouse's purchase counts, even on separate returns. The tempting answer is deducting $3,000 and carrying $1,000, but that's the normal capital loss limit. Wash sale comes first and blocks the loss currently.